Good evening, everyone. Welcome back to tonight's this ongoing training for doing business with DCF, this 5-part training series. Tonight, we are excited to have back with us again our presenter, Mr. Kelvin Sims, who's going to continue the conversation on the training on the financial aspect of things. Last week, we dealt with basic record keeping, and tonight he's going to jump into financial statements. And so this is going to give us some overall familiarity with the different reporting documents that reflect the financial health of your business. So with no further ado, since you met him last week, I'm just going to turn it over to him. Welcome the controller of Paradigm Precision, Mr. Kelvin Sims. Kelvin, the floor is yours.
Good evening. Good evening. Welcome back. So quick agenda, a little bit about me. We're not going to talk too long since we had it last week. Quick review of those terms what we looked at last time. Then we're going to jump into the financial statements. Look at the income statement, look at the balance sheet, cash flow, and then what you need to know about it. Just a quick summary of what you would need to know about them. Again, Kelvin Sims, Bachelor in Electrical Engineering from TSU, MBA from Nova Southeastern. Most of my life has been, 2/3 of my life have been in finance. Before that, I worked in the power industry, and I've enjoyed this finance piece a long time. I keep counting back the days, and it seems like it's been forever. So. And right now, as Jimmy said, I am the controller of Manchester at Paradigm Precision, the Manchester sites. So we talked about these last week, and I'm just going to go through them quickly just to refresh our memory. Our accounts payables, that's what we owe to our suppliers and our vendors for goods or services they've given us. Accounts receivables, that's money that's owed to us by our customers for the goods and services we give. Our assets, those are the positive things in our business, that resources we use to provide future benefits, i.e. cash or machinery, vehicles, things in that nature. They help us make our business grow. The balance sheet, which we're going to talk about tonight, and that is just a snapshot of your liabilities, your assets, and your equity. And we will talk about that a little bit more. Cash flow statement, again, we'll talk about that one tonight. And that is showing how the cash come in and out of the company. So we get cash from providing a good or service, and then we pay cash for our services or goods that are provided to us. To do our business, and also our expenses. So how does cash come in and go out? Expenses, just as they are, those are the things, cost of goods. Those are the things that you make a product or you provide a service. This is the cost associated with providing those goods or services to your customer. Then we look at our expenses. Expenses are your other items that may not be tied to your cost of goods, rent. You look at your supplies; those things could be a little bit separate. Your insurance, all those things are your expenses. The equity is taking your assets minus your liabilities, the things that you owe. Whatever is left, that's the equity that you would have in your company, positive or negative. Fixed and variable costs; those are just costs. Fixed are going to be things like your rent, your salaries, those things that won't change month over month. Your variable costs change with your output of your product and services. The more you have to travel to see patients or provide that service, the cost of your gas and the cost of the wear and tear of your car, those costs are going to go up. So they're more variable. Your gross profit is just that, is after you've paid everything and you look at your bottom line, this is the money that you have left over from your income and your sales. Income statement, we're going to talk more about tonight. That is a point in time that you can show your profit or your loss. Looking at all your expenses, looking at all your revenue for that particular time, and you can see where you're coming in, either positive or negative. As we call it, red or black. You want to be black as much as possible. The red, I love the color red, but not in the finance standpoint. We need to be on that black side to make sure we're making money. Inventory, those are the things that you have that are going to provide a good some type of product to your customer. Depending on the type of business, inventory is going to be high or low. A lot of things that you may do could be in supplies, will be in supplies, but for the most part, inventory provides that piece to help you make your goods or products. Liability, these are the things that you owe to a supplier or a vendor or a bank. Those are monies that you owe to someone else, almost like in the payable standpoint. And then the revenue, that's the money that you get paid for your sales and of your product and of your service. So just wanted to go high level with those again. Again, like we said, we talked about them last week. The three that we're going to be concentrating on, balance sheet, cash flow, and income statement. Some of the others will fall on those, but that's going to be the high level of today's discussion. So financial statements. So as a business owner, one should familiarize themselves with a few reports. And what these reports tell is the health of your business. There's some ratios that we'll talk about on each one of these that show whether the business is doing well, the business is barely surviving, or the business is in what they will call a fail mode. So these will just provide some basic understanding of the three. The income statement, again, also known as the profit and loss, tells at a given point in time what is your profit or your loss of your on a monthly basis or a yearly basis, to take a look at what has come in, what has been spent, and what other types of gains or losses that you've had in the business. The balance sheet, and the one thing that always helped me remember on the balance sheet, your assets must match your liabilities and equity. If you have an asset of $10 and your liabilities of $9, your equity is $1. So those things must match. I mean, that's why it calls the balance. And it must match to be in balance. We call it an out of balance sheet that we know we need to go look for why are we off balance. And the cash flow, taking a look at the money's coming in and the money's going out on a regular basis. How are we bringing more in, or how are we spending less to make sure we have a positive cash flow for our business? So the income statement, again, this shows how much money the company has brought in and spent, and the difference between the two over a period of time. Meaning, I brought in January, I brought in $100 of sales. My cost was $80. My profit for that month was $20. So that's the simple piece of how we look at our income statement. And again, it's the difference between what was brought in and spent over a period of time. So you can do, most businesses do an income statement once a month, and then again at year end to do year to date. So you can take a look at what did I do over this year of a profit or a loss on my business. Those categories we look at is the revenue. Again, what did I sell? What was my income from my product, or my goods, or my services? That is my revenue. Expenses, those are the things that I had to pay for to provide those goods and product and services to my customer. The gain is if we have a asset, or let's just say a vehicle that we're no longer using for the business. We sell that to someone, the vehicle is fully paid off. We sell that to another provider, another service, another company. Those monies that we make on that is a gain. Likewise, a loss is the same way. If we sold a car or an asset that we had that wasn't fully depreciated or wasn't written off our books, and we sell that and we don't make enough to pay off that expense, that would be a loss. Or if we had a lawsuit or something that we had to make a payment that something happened, that would also be considered a loss. So the bottom line on the income statement, this is just a key thing to remember, is my net income equals my total revenue plus my gains minus my total expense plus my losses. And we'll look at that a little bit closer in a minute. But again, the income statement, just key point here is this is the difference between what I brought in revenue and what I spent in my expenses over a period of time. So the revenues and gains, this looking at it in three different buckets. Operating revenue, again, the selling of the products or services. This is revenue or monies coming into the company from selling a service, selling a good. The non-operating revenue, this is rental income. If you have money in the bank, you get interest. This would be the interest on the cap. We call it capital or the cash in the bank, and also income from strategic partnership. If you partner with another business and you are getting some revenue or some gain from that business, that would be considered a non-operating revenue, meaning you don't need that revenue to operate the business. On the first one, to operate the business, you're going to need that revenue. That's what the business was set up for, was to make money in those products or those services that you are providing. Then the last thing, gain, again, one-time non-business activities, could be one of the things a lot of people we look at is saying, okay, 3 years ago, I made an overpayment to XYZ. They correct their records. They send me a check for $200. That's the money from other activities, because it had something to do with it at 3 years ago, but current year, it had nothing to do with the business activity. So that would be considered net money from other activities. And again, like I talked about for the car, the sale of a vehicle, the sale of an asset, sale of furniture, that will bring money in or bring gain in, that will be considered part of your revenue and your gain. So those three parts, the operating revenue, non-operating revenue, and gains are the three most important side on the revenue side for the income statement. Your loss, expenses and loss, primary expenses, these are the things that occur in the normal operating of the business. Your cost of goods, your overhead costs, again, your rent, your furniture, your rent, your salaries, and things in line with that you need those costs to run the business. Selling, as we call it SG&A, selling general and administrative costs. These are things that if you had someone marketing for you, they do other pieces of the business that are not related directly to making the product or giving the goods and service. So that's selling G&A or administrative costs. If you had a bookkeeper or a finance person, they would be in the SG&A, excuse me, SG&A part of the income statement. And then research and development. If you did research, you had to try to develop your product, you develop your learning, you develop those things to make the business better. Those are some primary expenses as well. Your secondary, again, non-core business activity, almost like the non-operating revenue. This will be interest you pay on or things in that nature. So you don't really need it for the business or create your product, but you needed it to keep your business going. So that loan wasn't just taken out for no reason. You needed to keep your business going or to purchase something to help the business, but it's not one of your core activities for the business to run. Your losses, one-time unusual costs, again, like expenses towards a lawsuit, would cause you to lose money that, number one, you probably didn't plan on in your budget to have that loss. That is just something that came upon you that you had to take care of. So an example of an income statement, our product, we said was 25,800, training 5,000, giving us a total revenue of 30,800. Our product cost, or our cost of goods, so to speak, $8,000, give us a gross profit of 22,800. Now we have some expenses. Our expenses are salaries, our rent, our interest paid, our transportation, utilities of $2,650, giving us an operating profit of $20,150. This month we sold a van that we no longer use. We sold it for $2,000. And we also had a payment of a lawsuit for $800. So our net income, taking our revenue of the 30,800 plus our gains of 2,000, so giving us 32,800, minus our expenses of $2,650 plus our $800 of the losses. That will give us a net income for that month of September of $21,350. So kind of like straight math, and just putting it in the right buckets. Again, the gross profit is your revenue minus your product cost. Then my operating profit is going to be taking out my expenses, my overhead costs. And then I have the gain and losses section of my income statement that will also be added to my revenue and taken out of my losses, and to come up with my net income. Again, revenue plus gains minus the expenses plus the losses. Some ratios that we use. So gross profit margin, revenue minus cost of goods divided by our revenue gives us our gross profit margin. And it is the profit, it's a profitability ratio that indicates the percent of the remaining revenue after deducting the cost of goods. So what am I making what percent am I making after I pay for my cost of goods? Your operating profit margin, your operating profit divided by your revenue. And this just analyzes the profitability at an operating level. So to take away your gains and losses, what am I operating at? These are the things I have on a regular basis that it takes for me to operate my business. And what is that ratio of my profit to my revenue? And net profit, taking all expenses, losses. So the net profit divided by your revenue would give you your net profit margin. So based on the income statement that we just took a look at, so our gross profit, our revenue of $30,800 minus our cost of goods, or our product cost of $8,000 divided by the revenue gives us 74.03% gross profit margin. Very good gross profit margin. So you take a look and say my product sells at 25,800 at a product cost or cost of goods of 8,000. That's a very good return on your investment of your product cost. And so the gross profit margin would be a 74.03. Likewise, we now add our expenses to this, and then we now have an operating profit of $20,150 divided by our revenue of $30,800. So we have an operating profit margin of 65.42%. Then we look at our net profit margin. So our net income, we look at the net income of $21,350 divided by our our revenue. We're getting 69.32% net profit margin on our money. Very good ratios in this situation. The higher this number is, the better. You really want your profit number to be as high as you can, not only in dollars but in percentage, because you say if for every dollar I spend, if I'm getting 74% back, or 74 cents back on it, that is a good return for me from a business standpoint. Some other ratios, return on the assets, return on, these are when you, after we talk about the balance sheet, these will make more sense. And so these are some more from the income statement. You're taking your net profit divided by your average assets. So you're combining both the income statement and the balance sheet. So the balance sheet is the business assets, liabilities, and the owner equity at a given date. Again, like we'll see in a minute, this is usually run at the end of the month or end of a financial period. Some bank or places operate on end of the month, calendar month, some in on a physical month. Physical month, and with the company I work for, we always end our physical month on a Sunday. So our closing process is always Monday to Thursday. And then, but we also operate on a 5-4-4, so 5-week, 4-week, 4-week. So, but most small businesses will operate on a calendar month. So on the 30th, 31st, that is the last day of the business. And then they look at how to start closing the books for that. So the balance sheet, again, assets, liabilities, and the owner equity on a given date. And then what it does is just summarize how much you have in assets and how much you have in liabilities. Of course, we want our assets always to outweigh our liabilities. That may not always be the case, but we want to have a plan to show how we're going to get those liabilities down below our asset. And that just may be simple time of paying a loan or note to the bank. Assets, that's what's owned, the business owned, or what you own for your business. Again, could be vehicles, furniture. If you own a building that you run your care center out of, it could be all those things that will help the business to grow and to continue. The liabilities, this is what the business owes. These are the things that could be in the form of loan, could be in the form of payables, because those are liabilities that if we close the doors, we still would have to make those payments to our suppliers and vendors. And then the owner equity, that's what's left over if you sold a business. So you sold all your assets and you paid all your liabilities. What is left over is the owner equity. That owner equity could be negative if you owe more than your assets. So the assets are broken up into different categories. Our current assets, those are things that are rarely converted to cash. Could be straight cash, it could be stocks, bonds, and other notes, but easily and readily I can convert that to cash. I don't have to wait 6 months, a year to convert that and get cash. Fixed assets are not easily converted. Those are the things that you need to help you make or make your product or give or help you to give the goods and services that you give. Again, vehicles, furniture, buildings if you own, not office space because that would be a rental, but those things that you own or the business own. Tangible, those are physical, existent, meaning you can touch them. The intangible, those are things that are not physical and you just receive money. Could be something like a payment that's due to you for the borrowing or rental of land or property. Those are things that you just don't, you see, but you're not physically able to touch. The reason for the revenue or the asset, I'm sorry. Operating assets, these are things you use to generate revenue, so they help the business grow. And then the non-operating, those are things that are not used on the daily operations. So you have them, but they don't generate the product or generate the services that you are providing to your customers. On the liability, very similar. Current liabilities, things that'll be paid off within the year. Long-term, like mortgages, are long-term. They're going to be paid off over more time. And then contingent liabilities, depending on an event that would trigger. If you were sued, you had some type of payment. Those would have been things that happened when an event happened that caused the lawsuit. So you would have a payment at a given point in time, or waiting for a settlement, something the judge or courts to settle that case. So we'll look at the balance sheet. When we're looking at the balance sheet, the left side must match the right side. You got your assets on the left and your liabilities and shareholders' equity on the right. Now, there's some people will put these the assets on top, liabilities on bottom, but this is the most used format. So you can look across to see that these two, your total assets and your total liabilities and shareholders' equity match. Again, from a current standpoint, those things that are readily available, so our cash, our accounts receivables, our inventory, any prepaid expenses. Prepaid expenses are things if you had a software that you're going to be using and you pay like $1,000 for the software. Every year you're going to have to renew that software. In the bookkeeping world, you can prepay that and you pay the $1,000, but use 1/12 of that every month for your expenses. That way, when you use, we talked about last week, the accrual base versus the cash base. If you use the accrual base, you can show that 1/12 of the $1,000 every month. If you use the cash base, that $4,000 or $1,000 hit when you write the check. And then also the investments are part of your current assets. Property and equipment, your land, buildings, equipment, and minus your depreciation, and then other intangible assets and any amortization, and that's just paying for those assets over time. And then on the right side, your liabilities, your current liabilities, your accounts payables. Those are the things that are paying to our suppliers, our vendors. Our note payables, those are your loans, quick, small term loans, accrued expenses, anything that, as we talked about before, we said last week, hanging up on the balance sheet, those expenses that I've moved money to accrual to pay them as they come in. A lot of times businesses will do for their taxes, maybe paying quarterly taxes. Those are somewhat like an accrued expenses. You pay them, you don't have your full tax bill until the end of the year, then you've paid quarterly tax payments to offset some of that burden at the end of the year. And some deferred revenue that you're taking some revenue. Again, all these are using the accrual base. You have revenue that you sold it and you made the sale in January, but the cash didn't come in until March. You would defer that revenue on an accrual basis. You were to defer that revenue to, I'm sorry, you would take that revenue in January, but defer the payment because you're waiting for the payments to come in March. And then long-term debts, those are just large mortgage type notes that you're paying over a long term, usually greater than 1 to 3 years. And the shareholder equity, this is the balance to tie the two numbers together. And this is what the owner of the business or owners of the business would have. So if I take a look at the left side, $472,000, then I look at my liabilities at $247,000. So I have a lot of equity in this business. And then adding the two, I will come up with the number, and that would be what my shareholder or owner equity would be for that business. Now, good thing here, it is a very asset heavy. which is a good thing, because if you sold the business, you would get a check or gain at the end of selling that business. If the liabilities were 490,000, then you would have a negative equity in that business, and can't say it wouldn't look so good, but it wouldn't be so good to sell that business because you would lose money on that sale. Once you get the liabilities below the assets, that's when the business become more profitable and for you to sell, or you to think about considering selling if you were looking at that. Some ratios: current asset versus current liability. Again, the ratio analyzed the liquidity of the current business. So if I have higher current or higher assets than my liabilities, that number will be a 1 or more. And you want that number to be more than 1 or a little bit higher than 1. So you do have that liquidity. Quick ratio: current assets minus my inventory divided by my current liabilities. Again, some looking at liquidity a little bit more, but here you're taking out your inventory because you would say, if I had to get quick cash, sometimes inventory may not be as quick to sell. Cash ratio: looking at your cash or cash equivalent dollars over your current liabilities. Debt to equity: your liabilities divided by your equity. This is a lot of times, this is used in our personal life when you go get a loan. They look at how much do I owe versus how much do I make, or how much do I have from a net worth standpoint. And then the debt to asset ratio: our liabilities to our assets. Again, this is looking at the leverage that a company has to, and how much debt is using versus its total assets. So using that example again, I thought I put it, our current assets and current liabilities. I'm gonna jump back so you can see the current asset in our number. It's the 149. Our current liabilities is the 47,000. And that's over to the right. Sorry for jumping back and forth, but that's over to the right. So you look at that. So my asset versus my current liabilities is a 3.17 or 3.17%. Higher than 100%, that is a good ratio because if something happens, sell my assets to pay my liabilities, I will make 3 times, a little bit over 3 times as much as I have, and I will pay and have 3 times as much of my liabilities. Quick ratio: current assets minus the inventory. The 149 again minus the 15,000 we had in inventory, and that gives us a 2.85% or 285% ratio. So 2.85 to 1. Cash: I have $100,000 in cash or cash equivalent divided by my current liability. So the cash, $100,000 divided by my current liabilities of 47 gives me a 2.1 or 213% or 2.13 ratio. Likewise, the debt to equity. Again, we want this number to be very much lower than 1. This is one where when it becomes over 1, you're kind of playing around with, I have too much liability or owe too much money, and because if I had to sell the business, I don't have enough equity in my business to make money off of my business. Likewise, the debt to asset ratio, my liabilities to my assets, I want this number to be as low as possible because I want to be able to, with my assets, again, if I sold a business, to pay those liabilities off at that time. Again, some more receivables turnover, taking a look at how much money is out there of my receivables that I've given a credit sell to. So most of us don't get paid as soon as we provide the service. So we always have some type of receivables. So this is just taking a look at how much and how fast the company is collecting the money from the sales that they make on credit. And then again, days outstanding, how much receivables divided by my credit sales times 365. And again, here you want this to be as low as possible because you want to be able to get your money as soon after the sale as you possibly can. Doubtful account, this is those you when you're having problems collecting. This is what happens. This is where they go to the doubtful account, or we call it in our line bad debt. And again, we have the auditors use this to look and examine what's the quality of the receivables, or what's the qualities of people paying you for the goods or services that you give or you sell. Cost of goods divided by inventory is our inventory turnover. And this is a saying, if you have inventory, how quickly do you turn it over? How long do you have the inventory in house? The best thing on inventory, you may have heard of this, you may not, is just in time. If I'm making a product that takes blue ink, I want that ink to appear to me as close to possible. When do I need to insert it into my product? That way I'm not holding on to it. That way I'm not storing it, and I get it in, I use it, and I get it out the door. And so those are just what they call turnover of your inventory. Days inventory outstanding, again, very similar to the days of sales outstanding. Your inventory divided by your cost of goods, which you just flipping the calculation above, times 365. And again, measure how long it takes the days to sell this inventory. So if you bring in inventory in January, hold on to it until June. That's a long time for the inventory, depending on what you're making. Could be a long time for your inventory. So you want, again, if the turnover of the inventory is a high number, high ratio, your days in inventory outstanding is going to be very low. And payables turnover, like we talked about the receivable turnover. This is how quickly you make payments to your suppliers or your vendors. Now, from a business standpoint, you want payable terms that you're making payments to as long as possible, 30, 60, 90 days, versus someone owe you money, you want 30, 20, 10 days. You want to get your money much quicker than you pay your money out. And the days payable outstanding, your payables divided by your cost of goods sold times 365. Again, this is just how many days it's taking you to make on average you to pay your bills. Now, some people can say, well, I want to pay my bills as soon as I get them. In a business sense, that may not be the best thing to do. What you want to do is to make sure you can pay your bills on time. Most places give you payable terms to pay your bills. So if they give you 15 days or 30 days to pay it, use it. Because if you have money in the bank, you're gaining some interest, or hopefully you're gaining some interest off that money in the bank, that you can use that interest for future growth of your business. So the payables should be paid on the days that, if they give you 30, take the 30. If they give you 60, take the 60, and just make sure you have the money available in those days to make those payments. So it's not like on our personal side, if you don't pay in 30 days, they start whacking your credit. If they give you 30 days to pay it, use the 30 days. That makes good business sense. But again, when you give your payment terms to your customer, you want that to be as short as possible. If you're working with a big company, a lot of times they have their own standard set of times they like to pay their suppliers and vendors. So a lot of times they would give you, say, we're going to pay you in 30 days, we're going to pay you in 60 days, and they make those payments there. When I was at Pratt & Whitney, Pratt had a very good reputation of having 75 days payables. And then they went on, they made a change to that. And so they said they'll pay you in 7 days, but they take a discount. And that discount can be anywhere from 0.1, usually anywhere from 0.05 to 0.1%. And what that does is, if we pay you early, we're going to take a little bit off the top for paying you early. Okay, the last one, the cash flow statement. The cash flow is a summary of how cash is coming in and going out of the company. How does the company manage its cash position? So I got my sales, I have my sales, and I have my expenses. How well does the company generate cash to make payments to the vendors and the suppliers that we have? It says to pay it, the debt obligation, and to fund the operating expenses. Now, this could be a positive, this could be a negative. You would always want to operate in a positive cash flow, because that means you're bringing in enough income to pay the expenses that you're generating, or pay your obligations that you're generating. Again, those obligations could be, the obligations could be loans, it could be utility bills, it could be any type of obligation or expense that you have as a business. So looking at it, where does the cash come from? Is it coming from an operating activity, meaning I'm selling a product or services to drive that revenue, or it's an investment, the change in my assets? Am I buying more assets or acquiring more assets or equipment to help me build or make my product or services? And then from a financial activity, from an investor or bank. We talked about the interest, having money in the bank give a little interest, or do I have a partner that I've made some investment with and I get a return on that money that I invested on a regular basis to help me with my business. From an operating cash from an operating, again, these are receipts from your goods and services. Could be interest payments from a loan or something that you may have given someone. Income tax payments. Payments were made to your suppliers for goods or service used in the production, or your cost of goods, in other words. Your salary and wages to your employees. Rent, and then all other types of activities or expenses that are related to your business. Again, these are the things that you are using, or cash that you're generating from the operating of the business itself. The cash from investment, purchase or sale of an asset, loans made to vendors, loans received from customers. So all those could be cash or cash generating that are from an investment standpoint. They're not used to help generate business for the company. And then from the financial activities, loans from banks, investments for others, giving out loan investments to others, or investing in their company, repayment of a loan, and payment of dividends, payment of dividends is getting money from some bonds or stocks that you may have, and those payments come through what they call dividends. Instead of the stock or bonds growing in value, they pay the dividends directly to you. And again, looking at the looking at the two types of cash flow statements. Company on the left, in December at the end of the year, looking at it, they had receipts from their customers of $86,772. They paid for inventory $7,400. Cash from wages, for the wages, they paid out $53,000. So the net cash from their operation was $26,372. From their investments, They sold property and equipment of 13,500. They paid cash to purchase other equipment of 17,500. And so they had a net cash flow from investing of $4,000. They had a loan repayment of 5,000. So when they take a look at all the cash coming in and going out, they had a positive cash flow of $17,372. So what that told them is in 16, you had a positive year. Could have been profitable, could not have been profitable. But from a cash flow standpoint, it made sense. It made said that they had a good way of bringing in cash to pay their expenses that they had for that year. Good job for that, for the company in 16. In 17, things went a little bit different. The cash went down from 86,000 to $45,879 for the year. Cash paid out for inventory was 6,000, so they didn't buy a lot of, since the receipts were down, they didn't buy a lot of inventory. Looked like they may have laid off a person or cut some hours back from wages at $43,000. So their cash flow from operations was a negative $3,121. So way down from the year before of $26,372. So if you're looking at year over year, you would have questions from an auditor standpoint, or even as a business owner, you would look at it and say, what did I do in 16 from my operation standpoint that I did different in 17 to cause me to have that type of difference or loss of revenue. From the investment side, the sale of the property, we sold $1,200 of equipment or property, and we made a purchase of $15,250. And so our net cash from our investment was $14,050. So here would be one of those times if you looked at your cash flow statement mid-year and saw your operations cash flow was going down, you may not have made that purchase of the equipment unless that was a true need to run the business. So sometimes it could be good to go negative because I had to purchase this equipment to generate more business for the future. So I was making a payment or making a purchase, I'm sorry, in 17 to help the business in 18. And then the last piece of this is the cash paid for loan repayment of 7,000. So I would say here, looking at it quickly, maybe I took the loan out sometime Q2 of 16, paid $5,000, looked like the $7,000 was almost a full year of payment. So my net cash decreased in 17 at $24,171. So good, I'm not saying from good to bad. There could be situations of why they went down. You can see the operations definitely went down. We would need to, as a business owner, we would need to understand why did my business drop some 29, 30,000, almost 30,000 from the 26,372 to the negative $3,121. We would need to understand why. And then these are the types of reports or statements that help you investigate and help you look at what the business is doing and how the business is looking for the future. So the three things that we really need to understand from a business standpoint are: one, the income statement. This provides the information about the business and expenses and the business expenses and revenue at a specific time. Like we talked about earlier, this is ending periods, usually when these statements are created. So I take and calculate or keep and track all my expenses, all my revenue, all my losses, all my gains, and I put that information in this income statement format, and it tells me my net income for the month or for the period of time. And again, these are usually done on a monthly basis and then also done on a year-to-date basis. So if I do a Q1, I do one, usually we would do one for March to show me what did I do in March. And then also I would do one for January through March to kind of see where how I'm moving for the full year, the year-to-date point in time. So most of these are for, like I said, the income statement is for a period of time. What did I do from 1 to 2 months, or what did I do for 1 month only? And again, usually at the end of the month is when these statements, the income statements, are created. From a balance sheet standpoint, this is a snapshot of our liabilities and our assets, and then our equity at a moment in time. So from a balance sheet standpoint, you can almost run a balance sheet anytime. We call it run it anytime, because what you will look at would be on the 15th of June, I created my balance sheet. So at that point in time, I know how much I have in assets. I should know how much I have liabilities, how much I owe my vendors, my suppliers, my bank, and then my assets minus my liabilities will give me my equity that I have in the company. Excuse me. And that would give me my equity that I have in the company. So I could say my equity is at a level where now I need to reinvest some of my assets to help me grow the business, or I need to sell some of my assets to pay off some of my liabilities to make my business a little bit stronger as well. And then on the cash flow statement, again, it's a valuable measurement of the strength and profitable and a long-term future look of the company. How does the company bring in cash? How does the company pay its bills? If the cash is, excuse me, if the cash flow is negative, what's driving that negativity? What can we do from a business owner to look at that and make changes to have one, is it bringing in more customers, or is it selling off some assets that we are not using to bring in cash? Those things will help that cash flow statement. And again, as a business owner, we need to understand all three of these to help us look at and grow and evaluate our business. Again, from a cash flow standpoint, as we saw in the example, why did we go 30,000 on that top line? Why did we go from 26,000 to -3? On the investment line, what drove us to buy that piece of equipment or the other pieces of equipment? Excuse the typo in there. And then from an investment, why did we have more interest or more cash payments on our loans? Again, did we take the loan on the 2016? Did we take the loan out in Q2 or at the end of Q1? And in 17, we had a full year. Those are the things that we would need to look at to evaluate why our business had a negative cash flow. Again, some of them, once you have the statements, they're fairly easy to analyze because nobody will know your business better than you. You would know why your cash was down, your sales were down year over year. You would know why you purchased that new equipment or equipment in the second year when the sales were down. And you also know when you made you got your loans or your investment payments and things. So you could tell what happened to the business. I'm gonna back up just a little bit more, look at the income statement. Again, the things that we need to look for. Excuse me. So if we were looking at this business and our total revenue was 30,800 and our product cost, we just say was 48,000, we would look and say, what drove that product cost higher than what I made? Now, could be something simple. I had a expedite something, or I had to rent a vehicle because my vehicle's in the shop. I had to make a payment. So those are things that you should evaluate on a monthly, weekly, daily basis of what types of sales and what type of costs you're bringing into the business. And again, as we talked last week, we need to track all these expenses so we can make those evaluations on a regular basis to make sure we are doing the things that best and that's benefiting the business itself. Then looking at the balance sheet, the left side must be the same outcome or balance as the right side. I want my assets to be as high as possible or much higher than my liabilities, because if I have my asset outweighing my liabilities, then that means I have equity and I have some gain in my company. And so those are the two things that you really want to make sure from an income statement and a balance sheet liabilities, that we're always operating on the positive side as much as possible, as well as on the cash flow. We want to make sure that number is in the black. So we're showing that we are positive on all three of these. Again, provide income statement provides expenses and revenue, particular time. Balance sheet, asset minus liability equals equity, shareholder equity. So how much do I have gain in the company from the balance sheet? And then the cash flow, how do I bring money in and how do I spend my money to make sure the company is profitable and has good strength of cash. I think that's it. So at this time, I'll see if there's any questions.
Any questions? Anybody?
No, there's one.
There's always one. Somebody just doesn't want to be first to ask. Any questions?
I'm going to say not really any questions at the moment. That was a lot to take in. Definitely a lot to take in.
It is, but once you lay it out the first time from a business standpoint and understand where to plug the numbers, it is very easy to understand. The biggest thing on these statements are helping you look at your business and understand where the holes are, where the weaknesses are, so you can make changes and make the business profitable. Have we call it a nice balance sheet and good positive cash flow. Those three things, if you can do that, the business will be around forever.
Yeah, it definitely all makes sense, and just kind of, breaking it down and categorizing. And this training actually ends up being twofold for me, working for, Allpoint, from the business perspective. So I get, a lot of the financial piece of it from that perspective. Mm-hmm. But my son is currently purchasing a business that he's going to be taking over. So we're in the, we had a meeting with the financial person yesterday, for the business. So it's like seeing everything, and it's like, okay, I need a better breakdown of a lot of different things here, so going, being with the company that I'm with for as long as I have, and understanding, the billing and the collections, and the goods and service that we sell as an agency, and then on a whole different perspective, doing it now kind of in reverse from a startup perspective, so that I can help guide my son through. And we've got people in place to help, but it's like, see it all, it's like, oh, there's a lot here.
Yeah, don't be afraid to use some type of software to help you.
Oh, absolutely.
Quicken, QuickBooks are good, to help, especially the startup. And if you go to an accountant at the end and you can provide him with the reports that he or she needs, that they will love you for that. Yeah.
Well, I think this helps me to see more of, what we got for a statement from the company currently, and really how it really should be broken down is not like that.
Yeah,
So, there definitely needs to be a better breakdown.
yeah. Well,
Uh,
if you need
so
another set of eyes, I'm available. And, Jimmy has my contact information that we can lend a hand to you.
excellent. Thank you very much. Very informative. Definitely a little bit mind blowing, but definitely good information. Thank you.
Good, thank you.
All right, we've got a hand raised. We see Sheila.
Hi. My question is this: starting from day one, rather, is there some sort of a template system within, say, QuickBooks or something like that, where you don't have a bunch of numbers and everything to start off with, of course, but just sort of kind of programming things so that when that time comes, you could just plug in?
Yeah, QuickBooks is very good at helping you do those things. They have the, I'm not gonna call them generic, but they have the income statements, the cash flow, the balance sheet. They have those things readily available with the push of a button. The biggest thing you're going to need to have to do, and QuickBooks truly help you, is set up your accounts. So, for instance, revenue. I'll just use these examples. If my income is going to be supervising visitations, I get $300 a pop for that. Now, if that's one of your fixed prices, you can set that up in QuickBooks. So every time you go in and say supervised visits, they know it's $300. It helps you with your invoicing. If I need to send a statement to ABC, it invoices for you. So QuickBooks, I mean, it's a lot of people say, but it's very simple to set up, to set it up and get it into a place where you want. It gives you a chance to break down your expenses. I mean, if, let's say, for instance, if you are a t-shirt manufacturer, instead of saying ink, I got red ink, yellow ink, blue ink, black ink, pink ink. You can set up all different ways and have it. So it all depends on the details you really want to do to make, to help you run your business. Up front, you're going to probably do a lot of big generic things, but as you go further and further, you're going to want to divide those things into pieces. If you had, let's say, 5 employees, 1 driver, 1 that did services to this customer, 1 that did service to that customer, you can break, QuickBooks allows you to break all that up to really help you dive in and analyze your businesses. The three statements we just talked about are there, plus others to help you look at it. What's my accounts receivables? What's my accounts payables? All of that, if you set it up right or you use it, will help you generate those things that you need to drive the business.
Okay.
Thank you. Biggest thing I could say, Sheila, just don't be afraid of it.
Okay. I'll try not.
Right.
I have a free version of that because I used Intuit to do my taxes, but I just never used it because I didn't know how.
And look at it from a standpoint, it's a great way to track everything. You can scan now and upload documents into it, for keep. So when you go turn that over to, if you get to a point where you are using a tax person or a firm, you could just turn over, or depending on the type of QuickBooks you have, you can just give them access to that and they can pull the reports and everything that they need from that.
And I have just one last question. So starting in October, this 4th quarter, I changed business structure from a solo practitioner to an LLC. Mm-hmm. So I guess coming in, it would be an LLC. And I'm not sure, and this is a question that I will have for Headco later, is they need to stop paying me in my name and start paying me in my business name. And then I have to set up that bank account, which I had planned to do tomorrow
Mhm.
with the business name. And so I guess then I'll be calling back and speaking with Jimmy about how to sort of kind of make this transition from the solo practitioner phase to the LLC organization phase.
Right. Yeah. Piece of advice: if you're going to the bank, can save yourself some time. Write a letter on your business letterhead, give you the authority to open up that account.
I don't have any yet.
Oh, cool. It's easily created.
Oh, okay. Okay. I thought there was something special.
No, no, no.
Okay. Yeah, no, I can do that. Okay.
Yeah. And what that does is, you're going to need your paperwork that you open up the business to show the legal name and all that. But just a statement saying, the company XYZ gives Sheila the authority to open and close bank accounts, for the business. If you don't have it, depending on what bank you go to, you may have issues. I've known some banks will just have you go back and write it and bring it back with you. And again,
Okay.
that's just some things that from a business standpoint, they somewhat need that for you to open up that business account.
Oh, good to know. Thank you.
Mm-hmm. And if you need, again, like I say, if you need on a set of eyes for the QuickBooks, get in touch with Jimmy. He knows how to get in touch with me. I use it for a fraternity, treasurer of the Northeastern Province of Kappa Alpha Psi, and I do all my transactions. And I don't invoice a lot, but when I do invoice, it comes right out of QuickBooks. It keeps track of when people pay me. It keeps track of the little assets that we have. And at the end of coming up in about 2 or 3 weeks, I'll go through and do my final run through my numbers, call or send an email to my accountant or our accountant. He pulls the data right out. He runs the numbers. He gives us our final write-up, and it's all done without even, only thing I do is to write him a check, send it to him. So that's the easy part about it.
Oh, okay. All right. I will get into this tomorrow. Thank you.
Thank you. All right, Jason, you can't be the last one.
Any other questions for Kelvin?
I don't really have any questions. Just some of what you're talking about reminded me of, I have a business degree. A lot of what you're saying was kind of resonating with 20 some odd years ago from you. But yeah, very good information. Thank you. If I do have anything, I'll send it on.
Okay, thank you.
Yep.
Anyone else? Anyone else? Going once, going twice, 3 times. All right, you're letting Kelvin off the hook.
Thank you.
So thank you, everyone. Thanks for being here with us again tonight. As soon as this recording processes and gets sent to me, I'll get this uploaded quickly and get it over to you with the copies of the slides from this presentation. If you want to set up hours with Kelvin where he can potentially review any of your stuff, work with you individually as it pertains to your financial statements, let me know and we will schedule some hours with him. So with that being said, since there are no other questions, we thank you for being with us again here tonight. Look forward to seeing you next week, where we jump into the subject matter of contracts. So we'll see you then. Have a great night. Have a great week, and we will see you next week. Take care, everyone.
Thank you. See everybody. God willing.
Good night.
God bless.
Bye.
Thank you.
Thank